Who's the best, Neos QQQI or Kurv KQQQ? We're continuing our series of comparing each one up against the Neos QQQI and using the Nasdaq 100 as our source. Guys, it's Doug the Retirement Guy back with another exciting video for you comparing yields, fees, and the growth potential in the Nasdaq 100 derivative ETFs. This is something critical for all retirees to really understand of what is in your portfolio, what's building, what's creating your income, what's creating your growth to help you long term. I got to say thank you. Welcome back to all of our viewers. We have been adding new subscribers all the time, so I'm not the one who always asks you, but if you're not a subscriber, you're missing out. Hit that subscribe button. Also, we've added a lot of people to our Patreon. It's free. Don't be afraid to jump in on the Patreon. There's a lot of information behind the scenes that you can get, and then you can always support the channel that way as well. Let's get into today's video of Neos versus Kurv. So the yield showdown, this is a big thing here. Neos QQQI has been known great for income. And I've covered this many a times before, and it tells you that the Neos package is designed for income. You know, that was their whole #1 approach, is income from Nasdaq. So the 12-month trailing distribution rates are really running between that 13.5 to 14.1, and they pay out that monthly. It achieves this by writing covered calls directly against the broad Nasdaq 100 index, NDX. Now, they also have a complete portfolio that they've purchased that matches the Nasdaq 100. Okay, so they've bought those, and those are the equity that they have. Then they go out and buy the index and do the covered calls across the board on the index. Now, what's different between these two, Kurv, KQQQ, has an annual distribution yield around 14.4%. So just I'm going to give it just a tick higher in the yield category. Now, it operates an effectively managed portfolio targeting at high-tech giants and isn't strictly limited to the Nasdaq 100 index. And that'll be my first point of the day is I like the way they do that. They have an actively managed person, no different than what the Neos is using, except they are not playing in the realm of we have to stay in the Nasdaq index. We can buy what we want. We can do what we want. The goal is to have that high-tech giants produce those big incomes across the board. So you're talking about the Apple, the Googles, the Nvidia, the Amazons, the Microsoft. So when we get down to it, both of them are paying monthly. They have a covered call strategy on Neos versus an actively managed portfolio. The Neos uses the index. They use the tech giants. And then Neos uses a rule-based, index-based approach, while they're on the other side, Kurv is using an active managed system. So let's take a look at the expense ratios. Now, Neos is going to win this one, of course, because the 0.68% expense ratio versus a 0.99%. This shows you the differences in these. Now, I never buy a fund strictly because of expense ratios. It is a nice little added bonus, nice little added pump if we can go one way or the other. But across the board, all the numbers I show you today will always have these included into it. So it's really a moot point other than showing you that you're saving a little bit of money in a Neos that puts more money into your working capital versus the 0.99 that Kurv uses. Now, theirs is going to be slightly higher because of the management concentration approach that they are using. Okay, and they are actually targeting as much growth as they possibly can with income. Okay, so there's a kind of a magic little match between these two. So this one here, we got to give a little push over to the Neos side. Now, popping the hood on these two. This is something that I do for every fund. I call it pop the hood, take a look underneath it, what's going on. And we look at right now, QQQI is one of the giants out there. 12.45 billion dollars in net assets. We talked about the expense ratio, 0.68. Pays a dividend of $7.60 for right now, about a $13.50 yield. Now, those numbers will always change. As I've said, they will always change. They change by the hour. It all happens, whatever happens to the price of the fund, of where you're buying in at, and accordingly. Does pay out monthly. This one came out June 30th of 2024. So, we got almost, well, a little over 2 years already under this fund, under this design. Price range between a $50, $60, $57 range with the high of 57. So we're kind of at its peak right now, which is a lot in the marketplace. Is that you're going to find that way. Now we look at the drop off that we had in April. Then we see the W that came in here in the just past couple weeks, which it recovered. And now we're having a little bit slight drop off again as the day of the filming of this. We look at the performance over time. This is a critical one. Since inception, the average, so like I said, this is almost two and a half years now. The average is 20.92 total return. 1 year, 27.32%, year to date, 10.85, and in the past month, 0.95. So all positive numbers and some very, very big numbers from QQQI. When we get into KQQQ, $123 million under asset. So above our danger zone, above our, it's one of those zones that we get into. We've done a video on this to where you want to be above the $100 million mark so that you don't have to worry about liquidity onto it. 0.99 expense ratio. We talked about that, a little bit high. 4.1 million shares outstanding. Paid a dividend of $4.29 or 14.01. Okay, so less dollars, higher yield. That's why we don't chase yield, because that number is kind of just related to multiple different pieces of the puzzle. Pays out monthly. Now this one came out July 22nd of 2024. Okay, so we're about ready to have its second birthday, basically about 30 days from now. So it's a little bit, I'm going to have to say, just a hair newer across the board. Now, the price range on this one is $30 to $31, weekly high of $31.84. And you can see that they had the April drop off. They had the W in the past couple of weeks. They've had the growth out of it, and they were having the exact same drop off. So very common tracing between the two funds, even though they're both working in the tech. One's working in the Nasdaq 100 to a T. The other one is using it to buffer to where it wants to be, not always in the same rules. Look at the performance. Since inception, 24.55. So about 4% points higher since inception. 1 year, 39.46%. That means the growth has been huge in the past 12 months. Year to date, 16.62. Again, we're seeing a huge growth in the total return and 1.88 over the past month. So when we compare those apples and apples, which we'll do a little bit later here in the video, is you'll see that KQQQ is actually winning the total return battle quite a bit. So let's take a look at the holdings. This is the final piece of the under the hood that we want to look at. And when we look at QQQQ or QQQI, it matches QQQ. So many Qs to talk about. So you see that they're 57%, almost 58% in technology. They do the consumer services. They do the consumer discretionary. Then they get into consumer staples, healthcare, and so on. And you can see NVIDIA, Apple, Microsoft, Micron, Amazon, Google are all in their top 10 basically across the board. So they're big tech, which we expect from a Nasdaq 100 fund. When we go over to KQQQ, we can see their tech is only 27%. So there's 30% difference in tech over what QQQI is doing. But remember, KQQQ was really designed for high tech, which confused me when I really studied this and looked at it. Their communication services is 7 percentage points up than what the Nasdaq 100 is. The consumer discretionaries are almost identical to each other. When I started looking at what did they do, well, instead of Nvidia, they're heavily into Google. When we look at their Amazon at 4.1, Amazon is 9.62. Then you get Intel, and you get the Broadcom, and then AMD. So you can see they have some similarities, but they're really heavily going towards select funds. Now, the other is I wanted to show you was the U.S. Treasuries that they did. They put a lot of money on hold, which kind of tells me that they're not using their entire portfolio out there, because in the market conditions, they can pull back or they can let things run. So it just shows you the difference between the two, that even though we say KQQ is a heavy tech stock, excuse me, it's heavy tech ETF, they're not as heavy as QQQI is, because QQI has to follow the rules of the Nasdaq 100. So again, we go back to review the yields very quickly. Like I said, yield-wise, right now, 13.5 out of NEOS, out of 14.1 out of Curve. So a little bit edge goes the Curve across the board between these two. It just shows you the difference, how close these guys are on income side of it currently, than the setup that we really were thinking of, that NEOS being all 100% income, Curve looking for growth, that they're both fitting virtually both the same in the income side. Now the question is, why does growth matter in retirement? Inflation does not take a vacation. Growth protects your future purchasing power. So don't just collect income. You want some growth from your wealth. I talk about this in my portfolio building, that you want to have a growth side of it, you want an income side of it. And this is where we really start getting into that. People always are like, they're chasing those yields. They're really like, I'm chasing yield. I want the big yields because I need the income. Well, you're missing it if you don't play into the growth side as well. So what I'm telling you is, if you have a fund that is 100% capped, and we see this like QYLD is a big one, with no growth side of it being 100% capped, you can see the pattern on the left-hand side here, that if you're keeping pace with inflation, the green line, you're going to stay flat. If you're going to get an increase in growth about 6%, you're going to see a nice $30 increase in your particular fund. If you have no growth, you're going to see negative. This is all based off of if your fund is capped or not capped. Well, NEOS QQQI, who buys the Nasdaq 100 equities and sells the index call options, leaves room for partial upside when the markets rip forwards. Okay, so they're not capping their funds. Remember, I told you they bought the equities. Okay, they bought the stocks. They bought very much the Nasdaq 100. And then they go out and not sell those and don't cap those. They go out and do the equity side of it. This is why the strategy means so much. So that the QQQI has that room for upside potential. That's a winner as we talk about growth. Now, Curve at the same time holds 25 tech giants, dramatically writes calls against its holdings, and it's not forced to write options on everything all the time. So this is why I say they are flexible again to do what they need to do and allow their fund to breathe and run. So both are non-capped, okay? And when I say non-capped, doesn't mean that they don't cap some of them, but they're open to allow funds to run, and Curve is allowed to collect more upside capture in their strategy. Now, when we say this, we're comparing it with like the old way of the QYLD, who fully caps the upside participation because they're selling all covered calls on their entire portfolio. So this gives you the idea that, QYLD is not going to have the growth. It's going to create income. Does it create enough income that you have to roll some back in to cover for inflation? Big question. But that's a positive with NEOS and Curve, that they don't have that. When we take a look at the growth rates, though, because Curve is not always or excuse me, NEOS is not always have the highest, the fanciest, the forward-looking funds because they're doing the Nasdaq 100, which has had a great run lately. Their growth rate's 4.53% year to date. Curve, who is allowed to run a little more fluctuant, they're allowed to run a little more out there, has had a 9.12%. So you're looking at a good 4.5%, almost double what NEOS is getting in the growth category. So remember, yields were almost identical to each other. Okay, maybe a half a point difference between each other. Now we go to growth and we're gaining almost double, 4.5%. Okay, so you can see the difference in the two funds already, that with that growth and the potential for upside. And why do you need growth? As I told you, you have to beat the inflation sides of things. So KQQQ is outperforming QQQI year to date with the growth. And I believe they have the ability to do that on a fairly regular basis because of their strategy that they have in place. Now, not all incomes cap their growth. And I've told you this before. This is just another repeat of what we just went through. And that is the data-driven strategy that NEOS uses. It leaves that room for that captured potential upside. And then it has a broad diversification across the Nasdaq 100. Curve uses a high concentration active management, as it holds those 25 conviction tech titans. It's not forced to write options on everything that it has, so it can capture more explosive single stock movements better. Okay, so this is, again, I'm going to stop here and explain one more time. NEOS is looking for the entire NASDAQ 100 to rise, while Curve has about 25 funds that they're looking to watch grow. And they are watching more of the single stock funds. So if it's Amazon today, if it's Alphabet tomorrow, however it goes, they're watching their single stocks, and one's going to drive dramatically. Now, it forces the exposure to the highest conviction tech leaders. So they have to stay in that tech side of it. But both of those have great potential for upsides, which we just showed you. Now, Curve right now is winning because of the way they've done it, a better win cycle. The old way is the QYLD. Now, personally, I'm going to tell you up front, I own all three of these. I own all three of these, and I see this this is why I wanted to do this video, because I see this in my portfolio very, very strong. NEOS has some nice growth. Curve is having better growth. Both of them have great income. I go over to QYLD, who has income, but never is growing. When the big when Nasdaq took off and had a big run, QYLD didn't go anywhere because it uses a rigid, fully covered strategy that caps the upside of every single time. There's no participation beyond the strike price. It's designed for income at the cost of long-term growth potential. So 3 different strategies, 3 different ways of handling it. 2 are, in my book, are winners. 1 is not a winner. They will all create income, all at different levels of income or similar, close to the same income. But it's the growth side that makes the winning factor across the board. So the verdict on the growth, KQQQ, definitely the higher growth potential. QQQI gives that smoother growth, maybe not as much, but smoother across the board. Now we get into the big number that I tell you all the time. This is important to me, and that is the total return. It tells me what's going on with my fund. It tells me where we're going with it across the board. 10.85 year-to-date total from NEOS and 16.62. So almost about a 6% difference between the two. That will make some big differences, okay? Now, why do I always say total return means everything? Well, you want to look at the total returns, and we know, we've already showed you 4% growth in NEOS. That means we got about a 6% income in about the first 6 months. So about we're using about 1.5% basis points is for income a month. Now, Curve is 16.62. Now, we take 9% off of that, which means we got, again, about the same number of income, but we're seeing it's all built off of growth. So the real answer to these things, and this is how you take a look at total return. When you look at it, Where are you at? What's going on? Always use the year to date is the best one, and then look at long term for long focusing plans. Now we get into the next big one, tax efficiencies. Now we've talked, NEOS is really the king of the tax side of it. They do a broad-based income option. Okay, they use the favorable tax treatment, which because they're doing it on the index, they're gaining those 1256 contracts are automatically taxed at a blending rate of 60-40, 60% long-term, 40% short-term. So this can drop your tax bill significantly than ordinary income. Now, they also use, which a lot of people didn't know this, but they also use two next big things. One, return of capital. Now, I just did a complete video on return of capital to explain this very carefully, very easily. Return of capital helps I call it kick your can down the road of your tax burden, reducing your cost factor on paper. The other one they use is tax loss harvesting. Okay, so they're always looking at what funds, if they lost money on, what can we sell off at a loss to use it for against the tax side of it to help reduce that. So they really work hard to make sure the taxes are very, very low on the NEOs. Now, Curve does not go that far. Curve just uses a return of capital. Now, they use pretty much up to about an 85% ROC. So 85% of your distributions are being classified as return of capital. I am not against return of capital if used properly. It can be used as a defensive mode, but it can also be used wrong way of hurting on your NAV to keep your basically your yields up, so make sure it looks good on paper. We see that a lot with the weeklies. Now, they do use an investor-friendly tax reporting. QQQ issues a 1099 forms, so no K1s or anything like that. So they've really give you the transparency and the simplicity of the tax efficiency, but definitely not as strong as the NEOS package. So we're going to say they're both tax efficient in mind, but because QQI leverages those 1256 contracts, you got to give the swing, the takeaway to them is you got to give the swing to NEOS. So you can see how this pendulum has gone back and forth, back and forth, back and forth. So in conclusion, which is the better fund for your retirement package? Well, I'm giving you two different scenarios. And I'll give you the scenarios how it works. If you are investing inside a taxable brokerage account, I'm telling you right now, NEOS QQQI actually is the better advantage because of the tax, those 1256 contracts, those tax advantages. And then they add everything else into it. It's the tax side that does it. It's the 1256 contracts. It's the tax harvesting. It's the return of capital on top of all that. And then you get into the 0.68% expense ratio, a defensive, tax efficient powerhouse that generates income and growth. Now, if you're investing in a tax shelter like your Roth or an IRA type application, hands down, Kurv KQQQ is the fund to be a part of. It concentrates on that tech exposure, and that's the first thing I'm going to tell everybody. If you feel that the tech exposure is going to continue, that we're going to continue to see the growth and everything going through it, Curve is where you want to be. Okay? Higher total return potential. Taxes don't matter as much in a Roth fund or an IRA. Okay? So that ROC doesn't play much into effect. If you do put it in a taxable account, you have that in a backup. But you will pay more, unfortunately, when you go and sell or if you get zeroed out, you will pay more in taxes. But the maximum tech-driven wealth with the higher upside potential for over the long runs. So for me personally, I'm actually set it up exactly how you see this right now. In my Roth and my IRA, I have my curves running full storm. In my tax brokerage account is my NEOS running full storm. Both of these are into my income flow bucket. Okay. I pull both of these. I want that 13, 14% distributions. I want that income to live off of. And then with that growth, it just keeps the fund looking even better, stronger across the board. So guys, let me know what your if which one fits your strategy. If this is part of your retirement plan, let me know in the comments below. I'd love to hear from you. If you're more into scenario A, that you're in the brokerage account, or if you're just living off of the whole income side of it. Do you really see that the growth matters? Let me know your thoughts below. If best of all, hit the like button if you like what we're doing, and don't be afraid. Go into our Patreon, see if that fits you. Thanks, and we'll catch you next time.
Thank you for watching.